Howdy, Jacob here. Today we're looking at DigitalOcean Holdings in the IT services industry, 3.5 billion market cap, a billion greater enterprise value. They operate a cloud computing platform globally. They provide on-demand infrastructure and platform tools for developers, and they also offer infrastructure as a service. Been around since 2012, much more recent company. Their growth is very impressive. Gross margin, not as impressive as I would have thought, but even 55 to 60% is still pretty impressive. Still trying to find those operating margins, but with them growing as much as they are, no surprise to me. Looks like they'll probably have a lot of R&D spend, and we do see that. So about 20% of the revenue is being spent on research and development. That's taking money away from today to get more in the future or to become more efficient. So not all R&D spend works out, but if you do have a good amount of R&D spend and it is increasing revenue, increasing bottom lines, that's going to be a very positive direction for them. Balance sheet had a little bit of debt that we saw, so about 400 million cash on hand, cash-like products, with 1.5 billion in debt. So this is interesting. Their cash balance went up 1.6 billion, and their debt went up 1.2 billion. So I wonder what happened here. Maybe they went into debt to prep for an acquisition and then made an acquisition. Let's look at that. So the cash flow statement shows acquisitions being done and investments. And we see that they made a big acquisition here, 305 million, 99 million, and they actually made an investment here and sold off the investment. So that is kind of interesting. And it looks like they didn't profit from that investment at all because their debt didn't change, but their cash balance went down. Their investment balance went down like 400 million if you net out what they're winning positive in cash and cash and cash equivalents. Woof, English, come on. And so shareholders' equity is now negative, and their cash flow statement has good production of free cash flow. Oh crap, this is their okay. So capex. Okay, so they still produce positive free cash flow because they issue a lot of options through stock-based compensation, with the majority of their money going to share repurchases, acquisitions, and investments. But that current debt figure is a lot. You're looking at 1.5 billion in long-term debt with only 300 million cash, and your production of cash flow is 100 mil being generous. So that's over 10 times. That's going to be a problem for me. So let's make some assumptions here. I have a feeling it's not going to be pretty, but let's get to it. So I think they'll be able to grow a lot. I'm going to assume that a lot of money goes to acquisitions and reinvestment. And if they do that, they deserve a definite premium here. And as for margins, I think that they can get, they still haven't figured out that earnings margin, but for free cash flow, they're definitely pretty much there. And then for share repurchases, they're all over the place. 1% for them is 35 mil, but they don't produce that much. Just offsetting stock-based compensation is going to be a lot. So, 35 mil increase, 2 times that. Yeah, we're saying 1.5%. This is assuming about 25% of capital allocation goes to share repurchases because, again, they're stock option. I'm assuming all stock options turn into shares, and their stock-based compensation is a lot higher than what I project their 25% to be, and then 75% to get a massive growth through acquisition and reinvestment, and to keep these types of margins. So, even still, that's a fall 55%. I just have to do more research here. If it was looking like a buy today, I'd really need to look at how they're going to get those earnings margins to match the free cash flow margins. And even so, I like free cash flow better. So it'd just be offsetting the share-based compensation at that point. And the 15% of revenue is not easy, especially for a company that's 3.5 billion market cap. So they're gonna have to definitely figure some things out and become a more mature company, see how that rolls for them. But for now, it's gonna have to fall a bit before I'm looking at it. Hope you enjoy the video.